Thank you for joining me for Supreme Lending's USDA Rural Development Guaranteed Loan Program Training Part 1. Today we'll be defining the USDA Rural Development Loan Program, distinguishing between refinance options, calculating the loan amount, identifying borrower, property, and income eligibility requirements, differentiating between types of income, and listing asset documentation requirements. The United States Department of Agriculture Rural Development Guaranteed Loan Program is designed to assist low to moderate income households lacking sufficient resources to obtain standard financing when purchasing and/or refinancing a primary residence located in defined, eligible rural areas. The USDA Rural Development Loan Program highlights include purchases, new construction, and refinance transactions, serves low to moderate income applicants, offers 100% financing with no down payment, and offers 30-year loan terms with fixed interest rates. Closing costs may be financed into the loan amount. Gift and grant funds and mortgage credit certificates are allowed, and the loan program offers expanded qualifying ratios. Now we'll take a look at refinances. Refinances are available for borrowers with satisfactory payment histories. They provide lower interest rate to increase the ability for successful homeownership. The new interest rate must not exceed the existing interest rate. Applicants must meet all eligibility requirements. Supreme Lending offers two refinance options for USDA rural development. Those are the Non-Streamlined Refinance and the Streamlined Refinance. For the Non-Streamlined Refinance, a new appraisal is required. The maximum loan amount may not exceed the new appraised value, with the exception of the upfront guarantee fee. The principal and interest balance of the existing loan, reasonable and customary closing cost, and funds necessary to establish a new tax and insurance escrow account may be financed into the new loan. Direct loan borrowers that owe subsidy recapture have the option of financing or deferring the amount of recapture that is due. The borrower may be eligible for a discount if they finance the recapture. If electing to defer the recapture, or if unable to include the subsidy within the new appraised value, a second lien will apply and no discount will be available. Additional borrowers may be added to the new guaranteed loan, and existing borrowers on the current mortgage note may be removed. However, at least one original borrower must be an applicant for the refinance loan. The existing loan must have closed at least 12 months prior to request for a refinance. The existing loan must be current for the 180-day period prior to the agency's receipt for a conditional commitment request. The borrower must meet all standard credit requirements, and monthly housing expense to income ratio may not exceed 29%. The monthly total debt to income ratio may not exceed 41%. A debt ratio exception waiver may be requested when strong compensating factors exist, and the Guaranteed Underwriting System, or GUS, may be utilized. Now let's take a look at the Streamlined Refinance. A new appraisal is not required. A new appraisal will only be required if the current loan has subsidy recapture in order to determine the amount of recapture due. If recapture is due, it cannot be financed into the new loan. The recapture must be paid with other funds or be subordinated to the new refinance transaction. The maximum loan amount may not exceed the original loan amount at the time of purchase, with the exception of the upfront guarantee fee financed. Principal balance, interest balance, and reasonable fee for reconveyance of the existing USDA Rural Development Loan may be financed into the new refinance transaction. Additional borrowers may be added to the new guaranteed loan, and existing borrowers on the current mortgage note may be removed. However, at least one original borrower must remain on the new loan. The existing loan must have closed at least 12 months prior to request for a refinance. The existing loan must be current for the 180-day period prior to the agency's receipt of a conditional commitment request. The borrower must meet all standard credit requirements. Monthly housing expense to income ratio may not exceed 29%. The monthly debt to income ratio may not exceed 41%. A debt ratio exception waiver may be requested when strong compensating factors exist, and the GUS system may be utilized. Now we'll do a quick knowledge check. Which USDA Rural Development refinance option requires an appraisal to be obtained? Is it A, the non-streamlined refinance, or B, streamlined refinance? The correct answer is A, the non-streamlined refinance. Now we'll take a look at calculating the loan amount. The maximum loan amount is calculated using 100% of the appraised value plus the one-time upfront guarantee fee. When the appraised value exceeds the purchase price, the borrower may elect to include eligible closing costs in the new loan. The USDA Rural Development has two different calculations for the upfront guarantee fee based on if the applicant elects to include the upfront fee financed in the loan amount. If the borrower elects to pay the upfront guaranteed fee in cash, then the base loan amount, including any eligible closing cost, multiplied by the guarantee fee percentage rate, will equal the upfront guarantee fee that is disclosed on the loan estimate and the closing disclosure. If the borrower elects to finance the upfront guarantee fee into the loan, then the base loan amount, including any eligible closing cost, divided by 100% minus the guarantee fee percentage rate, will equal the total loan amount multiplied by the guarantee fee percentage rate, which equals the upfront guarantee fee disclosed on the loan estimate and closing disclosure. USDA Rural Development provides a guarantee and annual fee calculator online at their website under the Guaranteed Annual Billing and Payments section. Here we have an example from the guarantee fee calculator. In this example, we used $107,000 appraised value, $100,000 for the purchase price, and $5,000 for eligible closing cost. As you can see, the calculator does all the necessary calculations, including providing the guarantee fee with entire fee financed into the loan. Now we'll take a look at eligibility. Borrower eligibility includes U.S. citizens, permanent and non-permanent resident aliens with proof of lawful residence. The borrower must have a valid Social Security number, must meet income eligibility requirements, must agree to personally occupy the dwelling as their primary residence. Therefore, non-occupant borrowers are ineligible. Borrowers must demonstrate the willingness to meet credit obligations in a timely manner and must not have been suspended or debarred from participation in federal programs. Now we'll look at property eligibility. The USDA Rural Development will only guarantee loans made in rural areas that are designated as rural by rural development. This includes the following property types: single-family, non-farm residences, approved condominiums, and planned unit developments. USDA Rural Development has a website to assist in determining if the subject property and the household's income meet the eligibility requirements. The guaranteed underwriting system includes an eligibility check when a complete address and income are entered on the eligibility application page. There are three potential property determinations: eligible, ineligible, and unable to determine. The first example here is for a property address that is located in an eligible area. The second example is for a property address that is not located in an eligible area. You may also receive an unable to determine result if the property is a new construction, contains erroneous data, the website is down, etc. So if you receive a result of unable to determine, you can contact the USDA state office where the property is located for assistance to make the final property determination. Here are some property eligibility helpful tips. Be sure to enter complete addresses, including zip codes. Verify address through Google or other service to ensure the address is accurate. And utilize the zoom tools located on the eligibility page to view the surrounding areas, streets, etc., to help validate the response received. Let's do some knowledge checks. Borrower must meet which criterion to be eligible for a USDA Rural Development Loan Guarantee? A. U.S. citizens. B. Meet income eligibility. C. Agree to personally occupy the dwelling as their primary residence. D. Property is in a rural area that is designated as rural by the Rural Development. Or E. All of the above. The correct answer is E. All of the above. The subject property eligibility website returns unable to determine. The loan cannot be submitted to USDA with this result. True or false? The correct answer is false. You would verify that the entered data is accurate and contact the USDA for further assistance as needed when the result returns unable to determine. Now we'll take a look at income eligibility. The USDA Rural Development uses 4 income definitions. Annual income is defined as the income of all household members, regardless if the parties are responsible for the promissory note. The adjusted annual income is defined as the household's annual income minus certain qualified household deductions. Qualifying income is defined as the adjusted annual income compared to the established maximum adjusted income limits to determine eligibility. Repayment income is defined as the stable and dependable income from all sources that are used to calculate the debt ratios and determine whether the applicant has the ability to repay the loan. Let's first take a look at annual income. Annual income takes into consideration every household member's eligible income source. The adjusted annual income and the anticipated income for the coming year are computed in the annual income calculation. The income calculation is utilized to determine the eligibility of the household income. The following sources are considered in the annual income calculation: gross amount of wages, salaries, overtime pay, commissions, fees, tips, bonuses and other compensation for personal services, cost of living allowance or a proposed increase in income that will take place on or before loan approval, the income of an applicant's spouse, unless the spouse has been living apart from the applicant for at least 3 months for reasons other than military or work assignment, or court proceedings for divorce or legal separation have commenced. Other income sources include interest, dividends, and other net income of any kind from real or personal property, including the share received by adult family members of the household from income distributed to a trust fund, any withdrawal of cash or assets from an investment except to the extent the withdrawal is reimbursement of cash or assets by a member of the household. Household net family assets, non-retirement, of 5,000 or greater. Let's take a look at an example of income from assets. A checking account has $12,500 in a non-interest bearing account with a local passbook savings rate of 0.25% and a savings account with $1,500 that earns 0.85% annually. The first part of this calculation would be to take the $12,500 in the checking account and multiply it by the passbook savings rate of 0.25%, which equals $31.25. The second portion of the calculation is to take the $1,500 in the savings account and multiply it by the 0.85% earned annually, which yields $12.75. The final portion of the calculation is to take the $31.25 and add it to the $12.75, which equals the $44 in annual income calculation. Remember to include the greater of the actual income earned or the calculation based on the passbook savings rate. There are other sources that can be considered in annual income, which include income from adult full-time students who are not the applicant, co-applicant, or spouse. Count only the first $480 of earned income. Payments in lieu of earnings such as unemployment and disability compensation, workers' compensation and severance pay, public assistance unless excluded by law, net proceeds from the sale of a residence, home-based operations such as child care, product sales, and the production of crafts. Now, housing-related expenses for the property being financed, such as mortgage interest, real estate taxes, and insurance, which may be claimed as business expense deductions for income tax purposes, will not be deducted from annual income. Additional sources in the income calculation include the net income from an operation of a farm, business, or profession, with the following provisions applying: expenditures for business or farm expansion, capital improvements, or payments of principal on capital indebtedness shall not be used as deductions. Farm and non-farm business losses are considered to be zero. A deduction based on straight-line depreciation is allowed in the manner prescribed by the IRS regulations and reflected on the personal tax returns. Periodic allowances and payments, such as alimony, child support, recurring monetary gifts, and Social Security, are also sources that are allowed in the income calculation. Now, there are some types of income that are exempt from the annual income calculation. Some of those examples include earned income of a person under the age of 18 unless they are the applicant or a spouse of a member of the household. Income received from the care of foster children or adults who live in the household. Amounts granted for or in reimbursement of the cost of medical expense. Temporary, non-recurring, or sporadic income. This does include gifts. Lump sum additions to family assets, such as inheritances, capital gains, insurance payment under health, accident, or workers' compensation, settlement for personal or property losses, and deferred periodic payment of supplemental Social Security income and Social Security benefits received in a lump sum. Also included in exempt income are any earned income tax credits, adoption assistance in excess of $480 per adopted child, amount paid by a state agency to a family with a developmentally disabled family member at home, the full amount of any student financial aid, any other revenue exempted by the federal statute, and lists are available at any rural development office. Income received by live-in aides, employer fringe benefit packages, unless reported as taxable income, amount received through the Supplemental Nutrition Assistance Program, or SNAP, housing assistance payment, also known as HAP, the HUD's Housing Choice Voucher Homeownership Program, sometimes referred to as Section 8 for homeownership. HAP is not included in the household's annual income for the purpose of determining the income category in which the household falls or determining payment assistance. Once all income sources are verified, a projected calculation of the expected income for the next 12 months must be determined. The projection should be based on a comparison and analysis of the figures derived to establish earning trends to avoid underestimating annual income for the household. This calculation is used only to determine the household eligibility and does not necessarily represent stable and dependable income for qualifying the loan. USDA Rural Development utilizes the number of days in determining year-to-date figures. To correctly calculate the annual income, take the year-to-date income and divide it by the day of the year. Then multiply the resulting figure by 365 to get the annual income. For example, John Doe's verification of employment dated September 30th, 2018 shows year-to-date earnings of $61,425. September 30th, 2018 would be the 273rd day of the year, so the annual income calculation would be $61,425 divided by 273 multiplied by 365, which equals $82,125. Let's do a few knowledge checks. Becky has worked at Supreme Lending as a mortgage loan closer since May 2018. Becky worked at ABC Mortgage Company in the same role for 5 years prior to joining Supreme Lending. Becky's income from ABC Mortgage can be averaged with her income at Supreme Lending to obtain her annual income. True or false? The correct answer is false. Becky's employment with ABC Mortgage has ended, therefore it cannot be used in the income calculation. Remember that with annual income for USDA, we are looking at the projected income for the next 12 months. So in this example, her previous employment income cannot be used in the annual income calculation. For our next knowledge check, Josie has annual income of $75,500. Her tax returns reflect a business loss of $25,000. Josie's adjusted annual income with the consideration of the business loss is A. $50,500, B. $75,500, or C. $105,500. The correct answer is B. $75,500. Remember that business losses are treated as zero for annual income. In this knowledge check, John Homebuyer has been employed at Freddie Mac for 5 years. John's verification of employment, dated 9/30/2018, reflects a year-to-date base pay earnings of $35,901.39 and also indicate that he will be receiving a 5% raise beginning October 1st, 2018. John's mortgage loan is scheduled to close on October 31st, 2018. What is the correct income calculation? Is it A, $48,000, B, $49,400, or C, $50,400? I'm going to give you a moment to do the calculations. The correct answer is C, $50,400. Remember, when you're calculating the annual income, you must utilize the most representative of income likely to be received during the next 12 months. So in this case, we would need to consider the 5% raise that John is receiving on October 1st, 2018. Now we'll take a look at adjusted annual income. Adjusted income is calculated by subtracting any of these 5 deductions. Number 1, the dependent deduction of $480 per household members under age 18 years old, disabled members, or full-time students 18 years of age or older. Number 2, elderly household deduction of $400 per household member that is 62 years of age or older, or a person with a disability and is party to the note. Number 3, a deduction for medical expense for elderly family members only may be deducted provided the expenses will not be reimbursed by insurance or another source, and when combined with any disability assistance expense are in excess of 3% of annual income. Number 4, child care expenses for the care of children 12 years old or under. To qualify for the deduction, the applicant must identify the children who are receiving the child care, identify the family member who can work, seek employment, or go to school that's academic or vocational, identify the educational institution if the child care provided enabled a family member to go to school, demonstrate that there is no adult household member available to care for the children, and document the child care provider, the hours, and the cost of care provided. Number 5, deduction for the care of household member with disabilities, provided the following conditions are met. Expenses for the care is in excess of 3% of the annual income. Enable the individual with disabilities or another family member to work. Expenses are not reimbursable from insurance or any other sources. And expenses do not exceed the amount of earned income included in annual income by a person who is able to work as the result of the care provided. As a reminder, the loan file must have the supporting documentation for any of these types of adjustments. The evidence may come in the form of a receipt or contract from the provider, canceled checks or money order receipts, a letter from the provider, or if listed in the tax returns. Tax returns are not required but may be used. Let's do some knowledge checks. We have applicant household members: Josh, who is an applicant age 42, Josie, an applicant age 40, Julia, who is age 12, and Joseph, who is age 10. What is the household size? Is it A, 2, B, 3, or C, 4? The correct answer is C, 4. Josh, Josie, Julia, and Joseph are all eligible household members. For our next knowledge check, we have applicant household members: Josh, who is employed full-time, Josie is non-employed, non-student, homemaker who is not currently seeking employment, Julia, who is age 12, attends an after-school program that costs $200 a month, and then we have Joseph, age 10. Does the household qualify for an after-school program deduction? Yes or no? The correct answer is no. The after-school program cannot be considered because there was a family member at home who was available to provide care for Julia. So that answer again is no. Now we'll take a look at qualifying income. Qualifying income is the adjusted annual income compared to the established maximum adjusted income limits to determine eligibility. Utilize the USDA Rural Development website to assist in determining the household's income. The completed form Rural Development 3555-21 must be completed and uploaded to XDoc. Now we'll move along to repayment income. The amount of the applicant's income that is available to repay the mortgage loan debt and is considered stable and dependable is repayment income. Stable and dependable income is defined as the applicant's verified gross monthly income from all acceptable and verifiable sources that can be reasonably expected to continue for at least the next 3 years. There is no minimum length of time that an applicant must have held a position to consider employment as dependable. Many low and moderate income applicants change jobs frequently due to the nature of the employment available. Applicants in this situation should not be penalized for frequent changes in jobs within the same line of work if, despite the changes, income continuity has been maintained and the income amount has remained at a consistent level. Repayment income often differs from the calculation of annual income and adjusted annual income. It is calculated by using the applicant's past income earnings for at least 2 years, and any applicable training and/or education must be considered. Projected or hypothetical income from any source is typically not acceptable. Applicants that have not been employed with their current employer for 12 months or have experienced a significant earnings increase are considered high risk. There should not be any gaps in employment of more than 1 month within the 2-year period prior to making the loan application. Applicants must provide evidence supporting gaps in employment, such as college transcripts or military discharge paperwork, if employment gaps were due to attending school or military service. Exceptions can be made for seasonal employment, as is typical in the construction or agriculture trades. Reasonable exceptions for applicants with less than 12 months with a current employer can be made under the following circumstances. The applicant has recently changed jobs but remains in the same line of work. The applicant frequently changes jobs but demonstrates income continuity. The applicant is a recent graduate, as evidenced by college transcripts, or is a recent member of the military entering the civilian workforce, as evidenced by military discharge paperwork. The applicant has recently re-entered the workforce after an absence to care for a family member or minor child, extended medical illness, or other circumstance. The applicant must be with the current employer for a minimum of 6 months. The applicant will begin a new job with a firm offer letter from the employer indicating a start date within 60 days of loan closing. Many income sources such as commission, bonus, overtime, tips, and income from a second job require 2 years of receipt of income. Less than 2 years of these types of income may be acceptable with a documented, thorough analysis and a determination that the income is stable and will likely to continue for the next 3 years. For self-employment repayment income, the income is considered stable and dependable if the applicant has been self-employed for 2 or more years. Tax return documentation must support the length of employment. For other non-employed or non-self-employment income, it is considered stable as long as payments are made consistently to the applicant and are likely to continue for at least 3 years. Some examples of this include alimony, child support, public assistance payments, Social Security, and retirement. Now we'll do a knowledge check. Jana opened her own hair salon in January 2018. Before opening her salon, Jana worked as a loan processor at Supreme Lending for 15 years. Jana's income from her hair salon can be considered stable and dependable repayment income. True or false? The correct answer is false. Jana's self-employment income has been received for less than 2 years. Therefore, it cannot be considered stable and dependable. We'll do another knowledge check. Jordan has worked at Sparky Construction for the past 4 years. Jordan received 3 months of unemployment in each of the past 4 years. The unemployment compensation can be utilized in Jordan's income calculation. True or false? The correct answer is true. Jordan received the unemployment compensation consistently, thus it can be considered a seasonal compensation. Accordingly, it can be utilized in the income calculation since there is at least a 2-year history of receipt. Now we'll take a look at assets. An applicant is not allowed to have sufficient assets to obtain a traditional conventional financing with an LTV of less than or equal to 80%. All assets entered into GUS must be verified per the USDA Rural Development Guidelines, GUS approvals, and conditional commitments. Asset documentation requirements for checking or savings verification of deposit include a current balance that must cover cash to close requirements. The amount of assets listed in GUS must be the 2 months average balance for liquid accounts. An average balance must be consistent with current balance. Any significant increase must be accompanied by a written explanation and proof of source of those deposits. For gift funds, the gift letter must be signed by the donor and verified by bank statements or VOD proving the funds transferred from the donor's account to the applicant's account. For bank statements, original bank statements must be included for the most recent 2 years, and they must clearly identify the depository institution, account holders, account number, time period covered by the statement, all deposit and withdrawal transactions, and the ending account balance. For disposition of personal assets, documentations for funds obtained should include the bill of sale, a bank statement verifying deposit of funds, and a transfer of title if applicable. When borrowing funds on an unsecured basis, the applicant's median credit score must be 660 or above. The funds have to be used to pay closing costs and prepaids, and the new monthly balance must be included in the DTI calculation. Thank you for attending the USDA Rural Development Guaranteed Loan Program Training Part 1. The USDA Rural Development Guaranteed Loan Program Training Part 2 focuses on credit and GUS. And please always remember to reference the most recent Supreme Lending Guidelines on Supreme Insight and the USDA Rural Development publications available online. Thank you again and have a supreme day.